everybody to our Wednesday night webinar. As again, we're always excited to have everybody here. Our goal is to bring value. You can always put your questions in the chat. Sometimes we may wait till the end, but there'll be plenty of time at the end of this for Q&A. Remember tonight, the only professional on this call is Bill. We are not financial advisors. We are not investment advisors. We're here to provide education. Much of what Massive Capital shares is what we have learned through our experience from multiple areas. There is never only one answer to anything, especially to do with your taxes and financial situation. So you always need to make sure that you get your own professional advisement. So this is so every once in a while, Shrar throws a new slide at me to see if I'm paying attention on my entry there. So spend your time and money. So clearly I'm the last guy on this chart here, but when you're young, you don't have any money, but you've got time and energy. When you become an adult, you have some money, less time, some energy still. And then when you're old like me, you have money, time, and not much energy. I'm defying the energy. I'm going to keep going for a while. I'm the Energizer Bunny. But again, you got to make sure that you are spending your time wisely, right? That you're thinking about your future. You're understanding where are you on your path. So it's very, very important for everybody. And that's why there's not one size fits all in the financial market. It really depends where are you on your journey and what are your needs for your future. So we're going to talk a little bit about who Massive Capital is, our partnering opportunities. We're doing 2023 tax planning. You've got about a few weeks left to make some adjustments. Or once that magic time clicks, you're going to owe Uncle Sam maybe more than you want to do. And then we're going to have some Q&A.
I'm crying, Trevor, as you're talking about all this. I haven't finished. I know. Continue, please.
So we have our first in-person meetup coming up, a conference, I guess they are when it's over a few days. It's going to be in Dallas, Texas. You can scan yourself. Hopefully, Jasmine can put in the chat the link to sign up. And if you put the code in webinar, all capital letters, you will get $100 off any ticket. We'd like to see people there. We're super excited for this. It's going to be a lot of fun. So a little bit about Massive Capital. So you can see on the left-hand side, we're a vertically integrated real estate company. We specialize in ground-up construction, retail, flex space, industrial, and mixed-use multifamily. And we're also an owner-operator of value-add multifamily. On the left-hand side, we deal with equity. Brokerage is the triple net retail type facilities. Property management is also on the retail side. Development is on the retail side, but we might be expanding, or more on the commercial side, but we may be expanding that. We have a few projects that we've been working on. And then in construction, it's metal and construction wood. Those are two different things, mostly on the industrial retail spaces. Those are metal construction, and then wood would be if we were to develop ourselves the Georgetown project, for example, that we have that we're working on. You can see we're very, very Texas focused, but we do have assets in Colorado, North Carolina, Georgia, and we've been looking at development deals in Tampa and Phoenix. We are merging with Realty One, which we've been talking a little bit. Realty One has retail centers and retail, so they're about $290 million in assets. And then they've been in existence for 41 years, which is pretty impressive. And then the Massive Capital side, we've been in existence for 2 years now. And we have about 1,346 apartment complexes. We're also building the X Space in Houston, and we have $175 million in assets. And I always love to say it for anybody who's been here, you add those two together and we're close to $500 million. I always wanted to be able to say something with $1 billion, so it's very exciting to get there. So this is the extended team. So you'll notice a lot of the people that you're normally dealing with are in the first line. This is the direct Massive Capital team. And then underneath it, there's a mixture on the second line of folks that are with Massive Capital, but mostly on the financial side and on the Realty One side. And then you go down through all the acquisitions, leasing agents. So we have everything, in-house construction managers, we have leasing agents, we have brokers. So all of those things that we have are in-house through Realty One. These are the principals. So we have Shirar, who does most of these presentations, and Sanjay and Mike. Those are the original Massive Capital team. And then on the Realty One team that are merging, we have Bo, Alexis, and Pat. And they're our fearless leaders. So talk a little bit about what we've done this year. It's been a pretty busy year for Massive Capital. So I'm going to start at number 11. We closed our land development deal in Georgetown. It's 10 acres, just about 30 minutes from my house. Then we did Amberwood Apartments in Dallas, Texas, Warner Robins in Georgia. We raised money for the new X-Space development. It will start construction at the very beginning of the year. We did a value add asset in Denver. We do have one retail triple net in Conroe, which is a suburb of Houston. We're working on a new development in Katy, Texas. Big news, we closed our asset in North Carolina. We were super excited to be able to do that. We're working on a value add deal in San Antonio. And then we have our development here in Austin, Texas. And you'll see that on the right. We are 85% funded. The land, all of the entitlements are done, all the permits are done. We'll be closing. We're actually buying the land from an existing owner. And then we're going to start construction there at the beginning of the year. So if anyone is interested in this opportunity, reach out to anyone on the Massive Capital team. We'd love to have you on this deal. So it's a 1.72 multiple of your money estimated in 3 years. It's a 20% IRR. There is a 7% pref so that the investors get protected up to 7% on their money. So if the project does have some hiccups, we'll be able to do it. And it is a 3-year exit, which is a really good time use of money. And this is also an awesome project if you have any retirement funds for it. It's a really good use, and it's a nice quick turn of your money. So reach out to any of us on the Massive Capital team.
Trevor, just to add into it, our number 3. Oh, let me see if I have it.
Sorry.
Okay. That number 3 right there, that was a JV that we did, and we closed it.
Awesome. That's awesome. So yeah, this one is 20 minutes from my house. So it's the good thing about living in Austin. So Massive Capital, we partnered together as a team. So we do landowners. So we do joint ventures. So that other project was a joint venture. And then we'll help with the construction side of it. On multifamily, we can take care of value add. So the CapEx, asset management, credit improvements. So again, on many of those deals that I mentioned, we were co-signers on the loans. We raised a good portion of the capital. And some of them, we have local asset managers that we work with them and provide them on a weekly basis with a lot more data. We have some pretty high level financial guys that can provide a lot of insight for them to be able to manage their properties better. And then on the education side, so we don't talk a lot about this, and we need to start talking about it a little more, but Massive Capital has an awesome education program. So we have everything from a capital raising certification, a CRM that we have built and we have developed that is specifically for raising capital for real estate deals. We have our full, which is called basically, I call it the path to GP. So the goal is that our students actually become our partners. I think it's 16 people this year are brand new GPs. So like started the year and they're not GPs on a deal and they're GPs on a deal. And that's something I'm super proud of, that we've been able to do that. That's a great way for us to be able to add value back into the community. And then our goal is to partner with those people moving forward and to be able to do more deals and empower them to do more deals. All right, got your seatbelts on. We got Mr. Bill in the house. Everybody knows that there's always a lot of things. So I'm going to pass it over to Shirar and Bill. And again, if you have questions, you can pop them in the chat. and we will have plenty of time for Q&A at the end.
Cool. Trevor, thank you. So let me go back and recap a little bit. One of the things that we always mention that all the conversation happens here, it comes from our experience. Just like going to college, what we call it, I was an engineer. If you do undergrad, then you're out of your book in about 6 to 8 months. If you're a master's, you're out of your book in about 12 months. If you got a PhD 2 or 3 years out, you can expand it yourself out, right? So we have the same philosophy. Majority of the things that we talk about, it comes from our experiences. Trevor, how many deals you have done so far from the LPGP?
31. 31.
So
yeah.
Thank you. So when someone pulled the trigger 31 times, that person has seen it a little bit. I personally have done a little over 20 some deals on last 3 years. And Sanjay has done God knows how many. And all of our teams has done it, right? And all of our team members, we have done it. So we talk from that. And idea is that as we talk about those, it becomes a case study about frameworks and examples. It may or may not fit you directly, but the more introduction, more concept you can introduce, so you can go, do some study, do some thinking, do some soul searching. So one of the things that I posted in the LinkedIn that we did our 6th closing in the year. One of my good friends, he called me. I was like, how did you find 6 closing? Numbers do not add up. And the point is, depending on the time of the day and the economic cycle, deals are being made. It's not the same way we have done it before, right? And all those deals, all of our students, all of our partners, we run those shops. To close 10 deals a year, you have to underwrite at least 300, 400 properties a year, and then send out 30, 40 LOIs. And that's a massive exercise. So a majority of our thing right here, it comes from our pain and all the sucker punches that we have received. And that's what Trevor was talking about. For us, it's not a conventional training or coaching or mentoring per se, not like you go to YouTube University, watch some videos. It's more of an accelerator, like an internship. You come in, it's a grunt work. You come in and get to work, and we accelerate the whole process. That's why we like to say it's an accelerated program. And one thing I want to talk about here on the asset management, we are extremely proud of our new software that we rolled out, where we have a software that we have Power BI, but the way we integrate it is our software sits on any property management software, which we update every Monday. And in other way, we see more real-time data at a weekly basis before the property management company. So that is a really powerful tool for us. It gave us a lot of insights, and that's how we add value. In other way, we are not there, but we're there from the data perspective. So that asset management tool gave us a lot of insight about all of our assets, and then they all factor into that. And this CRM, again, this is our base cost, and we do it. It has a lot of automation and a website, and everything is built in. It's built in from us. We feel like gone in those days that without a tool we can come and do it, because 2023 has been a very rough time. 2024 will be even more interesting, and we need to have tools that's going to accelerate us just to stay on top of our game. So anybody who is coming into the real estate, unless you have tools that is helping you out, and it is semi-automated, it's just different, right? So that's why we're really happy about this one. We like it, so that's what we share. And again, our biggest thing is we like to grow together as a team, not individually, right? So on that, from that framework, so we'll talk about the case study here. Whole idea is that, yes, we typically talk about tax planning ahead of time. And for our example is, look, we have 5 more weeks left, 6 more weeks left for the year ends. And this is the last time, the very last leg of optimization of our tax planning. So we call it massive perspective. Time should be on our side. If we run against the time, that becomes a problem. So in other way, if I plan for 2024 today, I can maximize my plan. In the middle of the year, I can optimize. At the end of the year, I can do damage minimization, right? So think about this. If you have not done your taxes yet, you have 6 weeks to minimize your damage. And then if you have done the tax plans already, go through it one more time and try to tweak it up as you go. But the point is, we all as investors, or even not sponsors, all of us as we collect our checks, we need to sit down and optimize for that one, right? So that is the point we started, is that whole idea about this one is that gross earning versus net earning. So I'll walk you through an example. We did a webinar like this about 6 weeks ago. I'll do another version of it just to and I'll show you a little bit more how to go about it. So we believe that some of the information should be known and everybody should know about it and have talk about it. And I'll give you some calculation that what's the difference. Then Bill is gonna come in and he's gonna do some role play scenarios and how to go about it, right? So this is an example that we did, the gross earning versus net earning. On the left-hand side, we got a bunch of columns. Don't worry about it. On the here, there are 2 columns. On the top, it's MFJ, which is married filed jointly. Married filed jointly. Single people, we all love you, but we are married, so we said let's just look at from that perspective. Year 2020. So again, we assumed the tax bracket is this too. Year 2020, that family earned $300,000. And they did a tax planning. And so, they took home $300,000. So they earned 305, they took home 300, they retained 98% of the earning. Same family, year 2, 2021, they made almost $600,000, $570,000. So their earning went up from year to year, 186%, right? 86% bump, that's a huge earning. Everybody feels proud about it. You almost doubled the freaking salary, right? But then you go back out, the tax planning wasn't there. Now look at the taxable income, there was no loss, They ended up taking home $423,000. Yeah, it's an increase. Don't get me wrong. On top line, I doubled my salary almost, but I took home only 75% of it. So this is a lot of value erosion for not so much of a tax planning per se, or not so much of a tax optimization. Can that family could save all of that? Probably not. But could they do a little bit more better planning and keep maybe another 10%? 10% at a 500 grand, it's $50,000. That's your car. That's your 5 vacations. That's how, and that could be one fifth, 1/6 of your home, right? And that could be kids, 1/4 of your kids' college money. That's a lot. And I wanted to show you that a little bit more as a framework that earning matters, but also what matters, how much of that we take home. And especially if you have W-2 and you have 2 W-2s, or if you have a W-2 with a business, anything like that, when you stack 2 working couple together, the family household becomes a very meaningful size. Every percentage counts. And yes, nobody likes, and I use my brother-in-law, he hates doing the taxes, all this kind of other stuff. But the point is, if you spend every quarter 10 hours, 20 hours, and in the year, we work full-time for 2,000 work hours. And if you work 50 hours of those and get paid 50 grand for it, why would you not do that, right? So that's the whole idea here, is that, look, at the very end of the year, sit down. I'm looking at the survey. Almost half of us did not do the tax planning. Please sit down and spend the time, look at your revenue and look at your costs, figure out the taxable income right here. And then at the same time, this is also time you talk to someone like Bill, and that is the Bill. So Bill is gonna come back, talk about the details of it, but I want to share some example here that look at the earnings and that. Full disclaimer, I know this couple and they're a good friend of ours. But this is a real time example when on top of line, they worked hard here, they lost quite a bit of money. Having said that, sorry, not this one. No, it's a different one. So the question is, sorry, it's a different typo right there. So the question is, how do we optimize the P&L for the NOI? I kept the market sentiment in there because what happens is when time is bad, when there's economic turmoil, we all want to be in the protective mode, which is the time right now what's happening, right? A lot of noise happening, the global, the macro, the inside, a lot of things happening. But this is also a time you're emotionally vested to protect your assets. So use that and do your planning. So when market opens up, you're in a better spot. So on the right side, this is an example that, federal tax bracket. And then here is the capital gain and dividend, and what is the rate looks like. So the point is, there's a structured way we can go about it, just like a math. And we have a structured way we can use the framework. So the first thing when I look at the revenue is, how do I increase my cost? How do I decrease my time horizon of my investments, and then how do I decrease my taxable income. So ultimately, our goal is to reduce the taxable income, and taxable income has a lot of line items to it. On that note, conventional way of saying that there's loopholes. That is, to me, absolutely wrong way of saying it. It's a sales pitch. But idea is that, and I always say life is an open book test. Read the damn book, you'll know what the answers are. So all the rules are there. A good accountant, a good CPA, a good tax strategist, all they're doing, they're sitting down and looking at all the rules, and they're following the rules. So when someone says there's a loophole, a bunch of BS, right? The point is the rules are there, and we just use the rules. And to use the rules, we got to know what the rules are, and sometimes we don't have time. So it's not who, not how, or it's or how, not who, right? It's not the how, it's the who that we need to go. So we reach out to folks like tax strategists and we go. So on your left-hand side, that's what I was kind of covering, that, hey, the strategies is reduce the taxable income, increase the tax deductions, maximize the tax credits. Then you time your income and deductions, we'll talk about it. Then you restructuring investment for tax efficiency. Then improve your tax knowledge and working with tax programs. So the homework from here, our ask is that as you get out from here, try to spend some time during the break time, the holidays, to get the number 6 or 7 going, and especially number 7. On that full disclaimer, if the CPA charging you $1,500 to file your tax, that person is highly unlikely they are a tax strategist. Tax strategists, they work with, with the business owners all the time. Their goal is to find a way to optimize the tax. And as a byproduct, they do their taxes. Not the other way around, who get a software from H&R Block and punch in the data, right? I know it sucks. They're cheaper, but they don't optimize for the tax. So it's okay to be there. And at the same time, when you go Google it, just go through an interview process, and then we kind of go from there. So again, the point is, all of us should focus on these 6 things. And if we can focus on these 6 things, we should be in a better spot. The full caveat, as I gave it to Bill, when I get to the next slide, when we talk about earnings, there are 3 categories of earning usually: W-2, business, and other income. And when someone says something, you have to always understand money. Life is a closed-ended loop, right? Whatever happens, it's not that we don't pay taxes, right? We always pay taxes. We want to pay taxes. We just want to pay taxes far away from here, not just today. It's a time value of money. So our whole idea is that taxes are due. It's a good thing to pay taxes. Thank God we're allowed to be in that place to pay taxes, but we just don't want to pay it today. We want to pay it in somewhere in the future time. And that's where just goal is. And I think one more time, it's 3 kinds of earnings: W-2, business, and other income. And I say that because on the deduction, the tax credit will be depending on those 3 categories. Bill is going to talk a little bit more about it. Right. So this is where Bill comes in, right? So here, this segment, we're going to spend some time, a little bit here, to do a simulation. So let's say I am a client. I haven't done any homework yet. I don't know. I have my wife works and I work, or my wife works, she has a W-2, I have a business owner. And I need to get a hold of someone like Bill, who's a tax strategist. And then we go have a discussion. And this is a framework of it, that as you go, we always say there's a pre-meeting before the meeting. And when you go get on a schedule, get them information, that during the call, you ask them to come and you have them come into the meeting by reviewing the information or something like that. And then you have a meaningful discussion, right? So this is a way. And have you said that, Bill? Would you mind coming a little bit, talk a little bit about what you do? And then our request is, if someone were to show up who hasn't done anything yet, what do you expect that person to kind of stack up all the docs? So what the best way to have a meeting today?
Yeah.
And how would you guide them today, please?
Thanks. Good stuff there. Good stuff. Appreciate it. And so a lot of what we're going to be doing is, so we start looking backwards to kind of see, okay, well, what have they done so far this year? What have they done for the previous year? And we need to kind of get to know the client, kind of know, who they are, what they're doing. One of the big things, especially when it comes to real estate, is, are they working in another job? Is real estate their main occupation? Because while real estate is a wonderful way to help defer a lot of the taxes immediately. If somebody is not the real estate professional, they want to invest passively, there are still great benefits. It's just sometimes we may go through explaining reducing your taxes today versus increasing cash flow in the future with no increase in tax. So sometimes, and so like the example we had before, about the tax and the numbers there, the income, what it doesn't always show is you may have cash flow coming to you, so you're increasing your take home, but for the same tax bill. So like as a percentage of your total take home, your taxes go down, but it's one of those on a tax return, it's not going to show you, hey, where were my distributions? Where was my cash out refinance? So we kind of look at their situations, see what they're doing. In this one, a really good example of something we'd be looking at here. Many times the wages, the salaries, those tend to be the highest tax possible. There's no breaks, there's not a lot of stuff on them, but it gives us a good base to start with. The Schedule C, the business income, that has probably got the most meat on the bone, because now we're going to try to figure out, okay, what are they doing? What is their business? Do they have employees? Could they make themselves an employee? Depending on the type of business, some of the things, it's called the TCJA, Tax Cuts and Job Act. Most people know it as the Trump tax cuts. There were incentives in there, things like knocking off 20%. Imagine if you had a coupon that said 20% off your tax. So you only got to pay tax 80 cents on the dollar. But it's usually a pretty good thing. But it comes with a couple of stuff. You have to own the business, has to be a pass-through. You have to have either assets and or employees, and it depends on the type of business you're in. Something to look at. Something also a lot of the business owners do is they may want to defer the income. They may own the business, and so maybe they don't have any employees other than themselves, their spouse, or maybe kids. They may want to set up a 401k plan. There's ways to put away $20,000, $30,000, $40,000, $50,000. Could be done on a pre-tax basis. And then again, sometimes we look at their specific situation, and if they are in a low tax bracket, it might actually make sense to pay taxes. What I mean by that is, like in the other slide there where they had the different brackets with the taxes, it's one of those, hey, if you're only paying at 12%, you know what? Maybe we want to pay at 12 or 22% this year so that we don't have to jump up to 32 next year. Just kind of different timing things. So we also have a discussion of, what the rest of this year looks like. And then we kind of look, okay, well, what's the next 2, 3, 4 years look like? Because somebody who maybe is going to be going into retirement is going to be in a different situation than somebody maybe that's coming straight out of school. And so we also will work with like good financial planning people just to kind of do modeling as things go forward. But everybody's a little bit different. Everybody's a little bit unique. And now sometimes I have to be the one to go, no, you're going to owe tax. Again, it's kind of like one of those, difference between tax evasion and tax avoidance is about 5 to 10 years in jail. So we like to avoid taxes, but we don't want to evade the taxes. And so based on your situation and or, it works really well when somebody's married, maybe one of the individuals is interested in working in the real estate field. Then we kind of start looking like what they want to do. But again, it's perfectly fine to be just a passive investor. Me myself, I'm a passive investor. I'm in several passive deals. I don't get all the tax breaks up front, but what I do get is a lot of the cash flow and knowing that my growth, because if I keep taking it, reinvesting it, buying into new properties, again, it's defer, 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 die. So while dying is not our number one tax strategy, it is the way it works. So things also to think about then too is just, again, like, what do you own? What do you want to do? Remember, 1 out of every 1 people do die, but do you want to have all the money for yourself? Are you trying to pass it down to the next generation? Some of these things come into play as well. And maybe you already are in some investments. That's the thing I found with a lot of people. They're already in several passive deals, or they may already have several single family properties, and they've got a lot of built up losses, but they've maybe been afraid to sell the real estate because of all the tax. And we're able to look at it and go, look, you're carrying 250,000 worth of loss carryovers. That means you can sell this property for $150,000 of gain and not pay any tax. We're just taking advantage of the system that's already there. So we're going to work within the system to see what we can do to maximize your cash flow. Because kind of what this example here is showing is, as your income increases, the government starts taking bigger bites out of the apple. We have what's called a progressive tax system. What it means is the more you make, it's the more they take. But I mean, it's not just, say if they take 10%, if you make $100, they take $10, you make $1 million, they take 100,000. No. As you take more, their percentage gets higher. So they're taking even more away from you, which then actually becomes an opportunity. As you make more, then it actually makes more sense to have these tax deferred investments, because the return on your investment actually starts to become greater.
Bill, this is awesome. So
yeah, again, so it's looking at this situation. Some of the stuff I'd look at first is kind of like, okay, let's look at this business income. What does this person do? And what can we do? There's still some things, even in 2023, there's a few things we could do if we had to change their entity type. Now, one of the biggest questions I get is when they say, well, I have an LLC, will that help me? Just remember, LLC in and of itself does nothing. So having an LLC doesn't help, it doesn't hurt. It just means you have a vehicle to recognize business income. Now, the truth is, if you own it by yourself and you do nothing else, it will be taxed the exact same. Like in this example where it says the Schedule C business income or loss, if this person had an LLC or did not, the numbers would be the exact same. So it's what you do with that LLC that matters. Maybe you make an election to the IRS, say, hey, I know I have this LLC. I want to start reporting my income as an S corporation. Or maybe in certain cases, it actually could be beneficial to have your LLC taxed as a C corporation. So you keep the same name, you see the same tax ID number, but it's just, how do you pay the tax? And some of it depends on what industry you're in. Are you planning on taking any partners? What do you want to do? But if you start to restructure some things, because on a self-employed business, many of y'all understand, like Social Security, Medicare, if you've looked at your paycheck, you can see where they withhold the FICA, or OASD, HI. That's the Social Security, Medicare. That's a 15% hit. Now, when you are self-employed, you pay both halves. So when you have just, when you're working for a company, they withhold 7.5, 7.65 from your check, but they're matching it. You don't always see it. But if y'all are business owners and you ever look at your employees' checks and you look at what you're paying on it, you gotta remember, you're also having to match that number. And when you're self-employed, it's left pocket, right pocket, you're paying it all. So maybe we look at restructuring to some type of S corporation. Maybe you look at, if you're looking to syndicate something or do something better, maybe you set up as a limited partnership. Again, you might have had a really good year this year, but next year you're going to sell out and go work a corporate job or retire, whatever. So sometimes setting things up, we want to look a little long-term, because, well, you may save some money in one year. If your situation is going to be completely different the next year, might not make sense. It's kind of like even forming the S Corp itself too. Generally speaking, I say it starts to make sense when your profits exceed 60,000. Because below that, I mean, okay, I can show you a plan. Hey, here's how you'll save $3,000 in taxes. People are like, great, I'm gonna save 3,000, sounds good. Oh yeah, it's only gonna cost you $5,000 to do it. Wait, those numbers don't make sense. To tell you the truth, if I showed you a plan that saved 5,100 in tax and it's only gonna cost you 5,000, I get it. You're coming out ahead $100. But then it's a matter of, okay, well, what's my headache? How much paperwork do I have to do? What all is going to be involved? sometimes for the extra $100, it's just not worth it. So you want to make sure that if you are going to make a change, one, you plan on having these changes long term, and two, what's your cost benefit analysis? There's just kind of all these different things that come into play that really are best handled through a conversation.
Bill, so question on that one, right? So let me kind of say it this way. If you follow the life cycle of us, right? Usually, most of the case, and I mean, Tony's first time you come out of school and you can start figuring things out at the early 30s, get married, the kids, the leverage goes up a little bit. Mid 30s, you kind of sort of figure out, and 40s, that's where you kind of figure out whether you're swinging or not. Going back to the first slide that I was talking about, right? Life as a pattern. But on that note, sometimes it may make sense. Some particular time it makes sense to make the structure right now at a break even, so you can start playing it a little bit more longer term, right? You're setting yourself up for year 2 and a year 3 and a year 4. Even the year 1, you are break even, right? So have a little longer horizon, what Bill was mentioning, and then set it up. It may not make sense today. It may be, net cash negative. You're putting money out of your pocket. In terms of setting yourself up for a future expansion, a future benefit as you go, right?
Yeah.
Would you say that, Bill?
Exactly. It's like, actually, I don't think you're ever too young to invest. Actually, I think anybody who's a parent, you should be teaching your kids how to invest. I mean, if I literally have given these 2 books to my kids, Rich Dad, Poor Dad, and The Richest Man in Babylon. I highly recommend everybody who's a parent, you get your kids to read them. It's like you get them to understand a second stream of income. I mean, it's like, I know we were talking about the Warren Buffett earlier, but one of the other Warren Buffett quotes I've heard is, if you don't get a second stream of income, if you can't figure out how to make money when you're sleeping, you're going to work till you die. So have a much longer term. Look at the horizon. Look at what it's going to be. Look at what you're setting it up for. We use the tax structure, whether it's in an IRA, a 401k, a trust, things like that. But they all still have the same underlying thing of looking like, okay, I need something that's going to generate cash flow. I need something that's going to continue, that I don't have to monitor, okay, so it's great if you want to be a landlord, you want to be a single family, you want to be lead, that's all great. Me, I made the decision that I'd much rather be a passive, give my money to somebody else, and then I just kind of, as long as my money keeps getting deposited in my bank account, they don't hear from me. It's like the only time they hear from me is like, where's my check? Where's my check? So I think having a longer term, being a passive can be a great way to invest. It's, again, looking at a slightly higher definition. Now, my wife gets most of my money. Y'all get, all the extra.
Most all, man. They get to keep it all, if you ask me. So
that being said, that's because I'm married up. I'm very lucky to have to.
I have at least 2-3 layers up. So if you ask me. So let me kind of make the corner, right? So let's see, here we are, right? And I want to bring the survey out. Again, we did the survey with the keeping you in mind and what it is. Again, as we talk openly, because again, our goal is to introduce those frameworks as you kind of go. And this is interesting. We have a little over 60 folks here. We appreciate your time, but take a look. It's a 50-50 split roughly, right? So as a first pass here, if you haven't done your taxes, or if you did not plan for it, have a conversation. 30 minutes, it's confusing. Have 2, 3, 4, 30 minutes conversation. You guys will figure it out which way you go. This year may not make sense, but next year may make sense. Year after may make sense. It's all about staging the year 1, then executing the year 2 and 3. At least have a conversation so you can stage yourself up. Treat yourself as a business. And the second thing, you don't invest in an IRA, right? I'll run through a couple of scenarios and I'll finish the thing before we open up for Q&A in about 5 minutes.
Yeah.
Here,
the other slight, just asterisk on that too, again. So these numbers are good, assuming these numbers are all correct. The W-2 is pretty easy. Your paycheck is pretty easy. But how do you know that that's really your Schedule C profit? You also want to make sure you've got good books and records. You also want to, because those things, now I get it, it's almost December, you can say, hey, what'd you do for the first 11 months? But as an owner, you kind of want to know along the way. So it's like, you need to understand, you need to know, what are my revenues? What are my expenses? And then kind of, so you can compare them year over year, because it happens all the time. People sometimes make mistakes. They misclassify something. You might be leaving money on the table that sometimes you can figure out through a conversation. It's like, well, what are you doing for X, or what are you doing for Y? and just kind of figuring out some of these things of where you're going. And so there may be deductions that, you find out through a conversation you're leaving on the table.
100%. So I'll give an example, potential branch out from here, right? Keep in high level, keep in mind, money that we earn by trading our time is the most expensive. Money that our money earns, that's the least expensive. You want to bias it towards that way, right? It does not mean that we stop working W-2, then we go out there and do everything else. It's always a transition. It takes about 3 to 5 years if you want to make that move. So our position is all the time, if you're in W-2, your incremental benefit is much higher if you stay in a W-2 before you make a hard choice, right? To kind of play accordingly, everybody's different. In this particular case, one thing that, Bill, correct me if I'm wrong, if hypothetically that couple is say, one party is working, right? Second party from here, change that to an S corp probably. That could have a 401k, which is you're reducing the burden. And here they're maximizing the 401k. Now 401k, you don't have any control, but IRA you do. So there's always a conversion. So you put the money into the 401k, then roll it over to the IRA or something like that. So overall, you're reducing your taxable income from the very top line, right? And then from that business expenses, you categorize, right? Bill was talking about have a good book of business to make sure you can categorize it right. And one of the things that here is that deduction wasn't there. So if from here, there could be some other income, right, Bill? There could be some business income.
And specifically what happened in this case, the Schedule C owner, because the income went over 335,000, the deduction, the qualified business income deduction, was lost because they didn't have payroll. And so, as funny as this sounds, had they reclassified that Schedule C to an S corporation and paid the owner a payroll, so the same person, you don't have to go out and hire new people, you just pay the owner the payroll, you would have then been able to say, yes, not only did I have income, I have W-2 income, I pay employees. The IRS, that's the funny thing, they don't care who gets on the payroll, just as long as somebody's getting payroll. Now, all of a sudden, that opens up a qualified business income deduction for you, which could be up to 20% of your profits. So it's kind of like you could have paid tax on 80 cents on the dollar had you did a couple of things differently. And even with that, say you took a 50,000 check, you might have stuck 20,000 of that into the 401k, and then the company comes on top of that and puts another 25%. So you're actually getting like $32,000 put away pre-tax for you, and then getting a $25,000 business deduction or something more. And so the numbers start multiplying when you use the system that's in place. I'm not even, everything we're doing so far is all black and white. We're not even going into gray. This is just a couple of things the way that it's written there. Now, we may sometimes go in the gray, but I promise you one thing, we never break. It's like, okay, if this is the radar, we like to fly right here. We don't recommend funny strategies, and like there's always the water cooler talk. Well, I have a friend that does this, it's someone's kind of like, you know what, like I got a friend that drives 100 down the freeway, and he tells me all you gotta do is drive in the center lane. As long as you're not in the left lane or the right lane, nobody will give you a ticket. And his proof for that is he's never gotten a ticket. Okay,
that's right.
Not the advice that I really want to follow.
Everything is cool until you get an audit, right? Everything is fantastic till you get a ticket. So as we talk about it again, I know it's a real estate webinar, but I want to spin that around, bring it to the real estate, right? So first thing first, have a conversation. Imagine this 30 minutes conversation, declassify this one, bring back 20,000. Then it may cost $5,000-$10,000 with the paperwork, but still net you're in the money, right? So those are the meaningful conversation we gotta have. And I know them now. This year, I think last year that they taxed it, they paid almost nothing. So that's what. So now going back, so let's say we're in a case and we did the tax conversation, and then we have some optimization, right? Question is, what do I do? First thing first, on IRA money, you should spend every single dollar out of it. Don't let it sit down, because IRA doesn't get any depreciation, so it doesn't really matter. But invest the money, let the dollar roll, right? The more it sits down, worse it is, right? In a sense, always think about it. You can make a 20% return for 6 months. It is same, and the other 6 months it sits down. It's same as making 10% throughout the year. Let the money roll, so you can kind of keep it coming. So if you're not investing with the IRA, spend the money on the IRA and find some good, investments to go, because the thing is that IRA don't get a depreciation, so it doesn't really matter, but invest. And if you are scared to invest a big chunk, I would say find a good sponsor that could let you come in on a smaller dollar amount so you can kind of get that going. Second thing, let's say you went through a 2023 tax season, you figured it out, someone like Bill helped you out, and now you're going to go back and invest. They said, hey, go invest in a depreciable asset. So I'll use an example of here that what is going on. So if you think about it, if someone comes to us and say, hey, Shariah, I need some depreciation this year, right? I'm just using us as an example so you can kind of see it, how it plays out. This triple net, it's a development play. It doesn't have a depreciation component to it, so it doesn't go. So if you go into a new construction that doesn't have a building with enough bathroom and toilets, toilets and a kitchen, you're not going to get much of a depreciation, so it's not going to work. This value add, if you go into a multifamily, then this one closes in January, but you got to make sure that property closes before December 31st, right? So you get to lock it in this year. So if you were to make a decision today, invest in an asset that's going to get you depreciation for whatever reason, then make sure you have an extremely high certainty that deal is closing here. And the way you test it is that the closing date should be mid-December. That way you have some slippage for the time. So pay attention to where you go, pay attention to your investment hypothesis, and then pay also attention to what type of investment that you're doing so you can really maximize the dollar that you have and defer the tax as much as you can. So having said that, I think this was a good conversation. So I'll stop sharing. We'll open up for Q&A. Bill, this is all yours, brother. I feel like we'll get a few questions.
One more slight comment on that. So
Please.
If somebody uses their IRA to invest in real estate, that is actually still a very good and a very smart play. And just make sure everybody IRA. It's a timing difference. So don't feel bad if you cash it out. Don't feel bad if you keep it in. There's just some different dynamics. But just understand having it outside the IRA tends to be more favorable. It's not the only game in town. There's different things you can do. It's just one of those, it's an option. And so the best answer is just understand what your options are. Why are you doing what you do? And just make sure, you know why you're doing it, which is not always the same thing as, I don't know, that's what my parents did, doing what your parents did. Now, if your parents are rich and they're getting all this kind of cash flow, follow what they did. But if they're wondering where their money is and they're wondering how to pay bills and they're working this, maybe you want to try something different.
Just to kind of push the envelope on that one, once you get into the Roth or IRA, they have different kinds of IRA buckets. And trust, Bill has done more than 30. We have done more than 20 up of our 50 deals. We have pre-tax money, we have post-tax money, and with the pre-tax money, we have the IRA, we have Roth IRA, we have solo 401k. It's a whole bunch of things, but again, those will come in naturally into the conversation once you start the journey. So on that note, I would say, hey, please, 50% of us who didn't do the planning, have a call with the tax strategist. You got about 6 weeks. Till then, Bill, I'm going to open up for Q&A, and we go from there. You get to see everybody.
By the way, you got corrected a couple of times by participants.
Oh, okay. Hey, thank you. Cool. Okay.
But we all agree,
so,
you know how to fit 6 weeks into 4.
Yeah.
Oh, 4. Sorry, I've been in my.
You work way more than the rest
somebody
of us.
posted, though, that you could do 6 weeks of work in 4, and I actually, it's probably in 2. But
thank you. I was thinking in the middle of this month. Thank you for helping me out here. 4 weeks, fine.
Awesome. Thanks, Bill. That was awesome. I always say the only accountant that speaks English.
Yes.
We also talked about in those, and if anybody's question, we'll answer it. But one other thing we can do, some of those self-employed businesses, they can, when they create their own 401k, they can make that a self-directed 401k. They can use their 401k to invest in real estate as well, which then opens up the Roth option, because now they actually have a valid business. People will set it up, but you can't have a 401k, or you should not have a 401k if you're not going to actively use it in a real business, meaning you're not going to grease the skids. But if you have it and you're able to defer into it and keep it as an active plan, it's perfectly legal, perfectly fine. Some people set them up and they kind of do a set it and forget it. That's not the way you want to set up a solo 401k that person should use a self-directed IRA and make sure they use a good custodian for that.
Awesome, thank you.
100%. Bill, Trevor, if we stop recording so we can get into the non-recorded, unconventional questions so we can have more fun. So for everybody else after 7 p.m.